A sole proprietor running a landscaping business earns $180,000 in net profit. Under current law, she deducts 20%, $36,000, before calculating her income tax. At a 22% marginal rate, that deduction saves her $7,920 per year. On January 1, 2026, if Congress has not acted, that deduction disappears entirely. She will owe $7,920 more in federal income tax without changing a single thing about her business. Multiply that scenario across 26 million pass-through entities, and you have one of the largest scheduled tax increases in American history. Section 99A was created by the Tax Cuts and Jobs Act of 2017, which took effect for the 2018 tax year. The act permanently cut the corporate tax rate from 35% to 21%. But businesses structured as pass-throughs, meaning their income flows through to the owner's personal return, did not receive that rate cut. Section 99A was the answer, a 20% deduction on qualified business income designed to give pass-through businesses a comparable benefit to the corporate rate reduction. Pass-through entities include sole proprietorships, S-corporations, partnerships, and LLCs taxed as any of the above. Roughly 95% of American businesses are structured as pass-throughs, and they employ approximately 54% of the private workforce. The deduction was always designed with a sunset. It expires December 31, 2025, unlike the corporate rate cut, which is permanent. This asymmetry was a deliberate choice made during the legislative process to reduce the official 10-year cost of the bill. The mechanics of Section 99A are straightforward for most small businesses. You calculate your qualified business income, essentially your net business profit, and multiply by 20%. That amount is then deducted from your taxable income before applying the tax brackets. The deduction is limited to the lesser of 20% of QBI or 20% of your taxable income minus net capital gains. For the majority of self-employed individuals and small business owners below the phase-out thresholds, it is simply a 20% reduction on business income. The complications arise above certain income thresholds. For 2024, the phase-out begins at $191,950 for single filers and $383,900 for married filing jointly. Above those thresholds, specified service trade or business owners, which the IRS defines to include law, accounting, health, consulting, financial services, and any business where the principal asset is the reputation or skill of its employees, begin to lose the deduction. Above $241,950 single and $483,900 married, specified service businesses receive no deduction at all. Non-service businesses above the thresholds face a different limitation. The deduction is capped at the greater of 50% of W-2 wages paid by the business, or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. This wage limitation was designed to prevent high-income passive investors from taking the full deduction. For a consulting firm with high revenue but no employees, it can significantly restrict the deductible amount. If the deduction expires as scheduled, the impact on a typical small business owner is immediate and significant. A sole proprietor in the 22% bracket with $150,000 in QBI currently saves approximately $6,600 per year. A business owner in the 32% bracket with $300,000 in QBI saves up to $19,200. These are not theoretical numbers. These are actual annual tax savings that disappear on January 1, 2026, if legislation is not passed. The question is not whether the impact is meaningful. It clearly is. The question is whether Congress will act. As of 2025, the legislative picture is active but not resolved. Multiple proposals have been introduced in both the House and Senate to make Section 99A permanent or extend it. The Main Street Tax Certainty Act has bipartisan support. Congressional Republicans have consistently pushed for extension as part of broader tax legislation. However, the budget math is significant. A permanent Section 99A extension is estimated to cost approximately $800 billion over 10 years, which creates legislative friction regardless of political orientation. For business owners currently above the service business phase-out thresholds, one strategy is to adjust business structure to maximize the deduction while it remains available. Qualified REIT dividends and income from publicly traded partnerships are also eligible for the 99A deduction. Some business owners near the threshold have restructured to shift revenue into categories outside the specified service definition. These strategies should involve a qualified CPI. The rules are sufficiently specific that structure choices made without professional guidance can backfire. If you own a pass-through business and you are currently taking the Section 99A deduction, model what your tax bill looks like without it. Do that calculation today, not in December. If the difference is significant, and for most business owners above $100,000 in profit, it will be, that information should inform your cash flow planning and your conversations with your accountant. Watch the legislative calendar in 2025. If the deduction is not extended, the appropriate response is to adjust your estimated tax payments upward for 2026 before the first quarterly deadline. The pass-through deduction is one piece of a shifting tax landscape. The 2025 tax law changes every self-employed person needs to know covers everything else moving this year, so nothing on your return catches you off guard. It is on this channel.